What if I told you that right now is one of the biggest opportunities in decades for markets? And that is because that right now basically is one of the best times to invest in, well, basically almost everything. Bitcoin, stocks, real estate, bonds, they've all taken major hits this year. We are seeing many companies basically in a sell everything state of mind, many investors in a sell everything state of mind, but big investment firms like Vanguard, Berkshire Hathaway, sneaky old Warren Buffett are doing the opposite. They're buying. Let me repeat, the biggest, most successful players in the world are buyers. They're not selling. They know the lower it costs to acquire assets, the better it is for their investment portfolios. What else do they know that they're not telling us? You see, we talk a lot about the bull markets and the bear markets, and when everything's up and everyone's just, riding high on the bull, the euphoria is up, we're all just like, yeah, up only forever. Hardly anyone is thinking like a bear. I've done it, you've done it, we've all done it. Okay, it's easy to feel like a smart investor when your portfolio is up. But in bear markets, when everything is falling, we all feel like idiots right here, okay? That is until you understand that even with inflation reaching a 40-year high, now could be an interesting time to be loading up on assets. That's because according to data from the S&P 500 collected over the last decade, the bull market is not the best time to invest. As it turns out, that's actually one of the worst and highest risk times to be investing. Well, it should be obvious that buying the top of a market would not be such a great idea. More money was invested in the 2021 bull market than combined over the previous 2 freaking decades, man, proving without a doubt that the majority of investors often get it wrong. And while bull markets tend to last longer and to generate moves greater than bear markets, truth is, time after time, bear markets have provided better buying opportunities for long-term investors, rewarding those with a bear bias the most. Bears know it can't rain all the time, and those who position themselves accordingly will get bonus returns when everyone else starts showing back up to the markets. This is because historically, whenever stocks have been down 25%, they pretty much always soared over the next year, gaining about 20% on average, even if a recession or a global depression were to follow up on that. They also always soared over the next 3 years, average returns around 37%. Over the next 5 years, average returns around 83%, and over the next 10 years, average returns of around 214%. Market gains are highly concentrated around big rallies after bear market bottoms, because bear markets always turn into bull markets. But the nature of this bear market is different from others in recent history, because we are seeing it largely being caused by the Federal Reserve's deliberate tightening of monetary policy rather than as a financial or economic crisis, although they so often go hand in hand, don't they? Now, before telling you about strategies to invest, the mental barriers that we all face investing during a bear market, I just wanted to let you know about my weekly cryptocurrency investor newsletter. It's called Wealth Mastery. And look, we just jam-pack this thing full of alpha every single week. We do altcoin reviews, airdrops, NFTs, DeFi tutorials, market analysis, and much more. Join our 50,000 weekly readers by signing up for freaking free. It's free, so use the link down below in the description to check that out. So let's talk about how to invest during this tumultuous period. If we know that every bear market in history has bounced back at some point and turned into a bull market, and that this bear period is the very best time to invest, well, then we're presented with an incredible opportunity, aren't we? Then there are 2 main strategies that experts recommend. The first is a passive investment strategy, like dollar cost averaging, or an active strategy, of course, like long-term value investing, trying to time better entries into assets. Many exchanges make passive investing even easier by allowing users to make automatic purchases on a weekly or bi-weekly basis, and that's for stocks and Bitcoin and all that stuff. Look into it if you are doing dollar cost averaging. That set it and forget it method means that you can deploy a 5 or 10 year strategy in seconds by just setting up recurring purchases every single week and just automating the process of investing and dollar cost averaging into your favorite long-term assets. Although no one can predict short-term market movements, and of course the bear market of 2022 may have further to run and could go well into 2023. But by dollar cost averaging now, you'll be lowering the average cost of your existing positions, making it easier to turn a profit during market recovery. Now, with passive investing, you're not trying so much to time the market to try and get a perfect buying opportunity. You're just trying to increase how much potentially you DCA during a bear market because things are cheaper now. And that can result, of course, then in owning a lot more shares, a lot more BTC at lower prices, helping your portfolio grow faster during the next bull market. Now, when you deploy an active value strategy, timing the market then plays a much bigger role. Value investors look for specific moments in markets when assets are basically considered heavily undervalued or on a fire sale, if you will, so they can come and scoop up these highly valuable assets for less than they're actually worth when we see times of irrationality in the market. Investors pursue value investing. They learn to uncover the intrinsic value of assets and develop the patience to wait until they can be purchased at prices that are lower than the asset's intrinsic value. Now, active investors understand things like business models in specific sectors that relate to, changes in other markets. They try to factor in these things like interest rates, the increase and decrease in production and money flows, competitive advantages, all this kind of stuff to try to make their investment decisions. Bear markets are a value investor's best friend. Most people don't know where to start regarding value investing. It does take a lot of time to try to learn just one sector, let alone dozens of different sectors, and how they correlate with each other, how the rate hikes correlate to the price of Bitcoin, all this kind of stuff. But that doesn't mean you shouldn't start familiarizing yourself with the strategy, especially now when things are a bit quieter during a bear market. So, if it's a great time to be buying, what are you waiting for? Well, let's talk about the psychology of investing. To the average person, investing is simply buying something to sell it for a profit. Pretty simple, right? But during a bear market, many investors will simply sit on the sidelines in fear, watching the market go down and down and down and down and down, failing to invest until markets start running up again, till prices are back at all-time highs. That's not how you win. Earlier this year, a one-year US government bond paid almost 0%. Now it's paying almost 4%. Look, there's no time like the present to be paying attention. Things are moving fast in the markets. And if you don't know where to start, of course, then passive investing, just dollar cost averaging, that's the way to do it. If you don't have time to dive into all this stuff, just keep it simple, right? But more importantly, you should have a plan, any plan, and execute that plan, right? The best time to invest in your future will always be yesterday. The second best days, today. And the longer you invest in yourself, the greater your returns are going to be. One of the biggest mistakes that we've all made is, of course, waiting too long to invest our money. So don't keep making that mistake, especially during a bear market. It's a very interesting time to invest. Look, and no one knows when the market's going to reverse, how much lower we might go, but we will reverse eventually. The key is not to try to, time the market and worry so much about that. In fact, according to JP Morgan's analysts, the 10 best days over the past 20 years occurred after the big declines amid the 2008 financial crisis and the 2020 pullback during the onset of the COVID-19 pandemic. Had someone invested just $10,000 in the S&P 500 on January 1st, 2002, they would have had a balance of $61,685 had they stayed the course up until December 31st, 2021. If instead they missed the market's 10 best days during that time, they would have $28,260, and that's a damn big difference. So be consistent with your investment goals by investing during this period when everyone else is waiting for new highs or they're trying to perfectly time the bottom. You're probably going to be a lot profitable a lot sooner. Now, would you prefer to buy, of course, a $16,000 or a $60,000 Bitcoin? Would you prefer to own Amazon stock for the price that it was 4 years ago, because that's the same price it is right now, or you want to wait for it to go back to all-time highs? This is why bears are buying, and you might want to be considering doing it too. Have a clear investment goal for the next 5 to 10 years and try to execute again on that plan. But more than just buying low and selling high, there is a mental game that you've got to understand when it comes to investing. Now, whether your investment goes up or it goes down, your first natural instinct is going to be an emotional reaction. This will be the first thing that you're going to need to control your emotions. It's so exciting at the top and so depressing at the bottom. Don't let your investment affect your mental health. If it does, then change your plan. Maybe you're too invested, whatever it might be. Famous investors are always going to tell you that detachment, taking your emotions out, is one of the most essential qualities required for success in markets. So stay the course, give your investments time to grow, and avoid constantly watching the markets, chasing after the newest, hottest trend, following every social media influencer on what they're talking about, and investing the money that you need right now, because you might need that money, right? So it's only extra money you can invest in the markets right now. But whatever you do, just remember, the big boys like Warren Buffett, they're investing now before prices start to rebound. So ask yourself, what are you doing? Okay, that's it. Subscribe now. See you next time.